this is too big to ignore. This is a debt crisis coming. The Fed has gone too far, and now they know it. If that's the case, then gold knows that back to easy monetary policy is highly likely to begin to occur soon. And therefore, that is the bread and butter of the gold market. Erosion of the value of the underlying unit of the money because they liquefy the system and create river flows of excess. Yes, silver's under pressure, but silver right now is around $22.50 last I saw. Its prior two lows of the last several months are down closer to 22. So despite the pressure in silver, it hasn't managed to take out its prior two lows, corrective lows.
JPMorgan Chase CEO Jamie Dimon is warning that interest rates could go up quite a bit further as policymakers face the prospects of elevated inflation and slow growth. Though Federal Reserve officials have indicated that they are near the end of their rate hiking cycle, the head of the largest U.S. bank by assets said that may not necessarily be the case. According to momentum analyst Michael Oliver, a significant debt crisis is looming and cannot be ignored any longer. He asserts that the Federal Reserve, FED, has gone too far with its monetary policies, and this realization is dawning on them. This situation has prompted a crucial shift in the market's expectations. According to Michael, the likelihood of a return to easy monetary policy is growing, which is the fundamental driving force for the gold market. Not only Michael, but also Ray Dalio believes the United States will have a debt crisis and is closely watching the risky fiscal situation. CNBC reported on Thursday, citing an interview with the billionaire investor. How fast it transpires, I think, is going to be a function of that supply-demand issue, so I'm watching that very closely, said Dalio, founder of Bridgewater Associates, in the interview. The collapse of U.S. Treasury bond prices and rising interest rates pose a significant risk to global financial stability and could lead to a potential debt crisis. The bonds experienced a sharp drop in price, and although under pressure, gold didn't collapse to the same extent. However, Michael speculates that gold is anticipating a change in the Fed's policy trajectory due to the bond market's turmoil. He argues that the Fed is unlikely to raise interest rates given the current bond market conditions, even though it cannot openly express its concerns without admitting failure. This potential shift towards easier monetary policy is a positive signal for gold's future performance. We will now bring you clips from Michael Oliver's interview with Liberty and Finance. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
That the recent collapse in the T-bond market, and it was a collapse, okay, it was a crash-like event. We pre-called it a nuke event, okay, that would cause a major, one, it's in coincidence with gold now. It's trending with gold. In other words, as bonds went down in price since basically a high in April, okay, gold started down from a high monthly close in March and April, just below 2,000. And bonds collapsed, gold didn't collapse. Gold is eroded down about, we closed 1999 at the peak monthly close, so, we're 7% lower. Okay. Bonds have collapsed. Now, I think when the bonds turn up, and I think they will, and there's not, part of the reason for that is that the Fed doesn't really control the long end of the market. They control the short-term stuff and they have their balance sheet. But when the long end of the market collapses like it has and rates shoot up, that panics them. I recall very vividly that last year, prior to the October low in T-bonds, or the high in yields, it was a very sharp drop. We got bearish in late 2020, and bonds collapsed and collapsed and collapsed. And last October, they made a pivotal low that we predefined as a bounce point. But just prior to that low, during that process of collapse, Yellen was panicked. She expressed herself at numerous interviews and so forth that she was very concerned about the, quote, illiquidity in the bond market. She has not opened her mouth during this recent crash. Nobody from the Fed has expressed fear or concern about it, and they know they should because you literally have crashed the bond market. If you look at a price chart of gold daily and a price chart of T-bonds, you'll see that the bond market's gapping down, much like some wild commodity, okay? And gold has been eroding down over that same period of time since March, April, in sync with bonds. Now, I think the reason that we're in sync with the bonds this time around is that when there's a perception out there, especially among major asset managers, the Fed has gone too far. This event in the bond market is not something the Fed wanted or Treasury wanted at all. It is evidence that they're not in control. They may control the short end and be incremental and so forth, but that front end, that long end has crashed. I think what gold is anticipating is that the policy of the Fed since March of last year when they started raising rates, is going to end. There's no issue about it because we now have a bond market crash. They can't jeopardize that situation by further rate rises. They can't express their concern, though, because if they do, that admits fear and failure. So I think that's why we've had it. Now, recently, over the last 6 months, T-bond market has literally crashed. It's gone back below its October low of last year. Gold's October low of last year is in the low 1600s. So yes, while gold has been under pressure while the bonds have collapsed, hardly the kind of pressure that the bonds have been under. So it's in sync in the sense that it is pulling back with bonds. And I think when bonds turn up, and we think that is imminent, it's quite possible we saw the low this week, in fact, we think there'll be a short covering rally in the T-bond market, meaning yields are going to drop back down again. This is going to be an impressive rally, we think, in the T-bonds. I think the main buyers will be the Fed trading desk, unannounced and undeclared, and a lot of large asset managers like Ray Dalios of the world and so forth who see this as an oversold market, the bond market, see that the Fed cannot continue on their current course. They can't even bluff about it anymore. And therefore, gold will be refed its justification, resuming its bull market, namely easy monetary policy will follow.
Due to speculators adjusting their expectations in anticipation of potential interest rate increases, silver prices have faced considerable pressure this week. This decline is closely tied to the ongoing strength of Treasury yields, the U.S. dollar's support, and the Federal Reserve's inclination to maintain higher interest rates. The market sentiment has led to a series of sell-offs in silver, prompting concerns about a prolonged downtrend. However, according to Michael, these sell-offs in silver might not indicate a long-term downward trajectory. Instead, silver seems to be moving within a sideways pattern, marked by intermittent downward swings. Meanwhile, gold prices have also seen a decline, with expectations that the U.S. central bank may opt to keep interest rates elevated for an extended period. Despite dropping from its previous highs above $2,000, gold has not experienced a significant collapse. Instead, it has displayed a pattern of lower highs and lower lows in recent months. In terms of specific price levels, Michael suggests that for silver, a rebound to around $23.50 on a weekly closing basis could signal a positive turn, while surpassing $24.50 within the next quarter would indicate a more substantial breakout. Meanwhile, returning to the low to mid $1,900 range for gold would signify that the recent drop hasn't significantly altered the precious metal's status.
Silver is interesting in that now it may break those lows, but as gold has come down from its highs above 2000 early this year, it made a low above 1900, rallied back up in the high 1900s. It came down, made a slightly lower a couple months ago than that prior low. So zig, zig, zig. This time it flushed out both those two prior lows, a downward zigzag. It's like been three waves. By the way, three waves is quite conspicuous. That third wave better be a disaster, because if it isn't, that's all you get. Okay, so it's had three probes lower. Silver hasn't done that. Yes, silver's under pressure, but silver right now is around 22.50 last I saw. Its prior two lows of the last several months are down closer to 22. So despite the pressure in silver, it hasn't managed to take out its prior two lows, corrective lows. Of course, its low back in February was under 20. It was a very sharp drop. It dropped from like 25 under 20. But since then, it popped up to 25, 26. And has had repeated sell-offs that are redundant. In other words, it's the same price levels you saw a couple months before. So it's really not trending down. It's trending sideways in broad swings. Right now, it's in a downswing. So I would say to bears in gold and silver, you better make something really good out of this sell-off, because if you don't, this is your last one. As far as numbers on silver, I would suggest a back up around today's highs on a weekly close around 23.50. Should get your attention, indicate that the recent pressure is over, and especially above 24.50 anytime in the next quarter. That those are indications that any lid you think there is on silver is going to come out. In the case of gold, I think the numbers are in the low to mid 1900s. That it says, okay, if you thought this recent drop was the one that would kill it, then this is your last chance, bears. And if you get back up into low to mid 1900s again, your chance is blown. Gold's going to reassert itself back toward what? What could be a quadruple top price breakout. That will wake up the ever bears. They'll say, oh my gosh. Yeah. And so, but momentum will speak before that, well before ever getting back to 2070 again. But anyway, I think that's right now we're looking at one of these situations where the panic in the bond market has also been in sync with the recent pullback in gold, not collapse. And then when the bond market turns up, and we're already seeing evidence of that now, and we've got some numbers that go into effect next month, new quarter, new month, momentum numbers, that you get TLT, for example, which is a very active 20-year plus T-bond ETF, a couple points above where it is right now, it's starting to break out via some momentum metrics, not the price chart. But I think that could create what you might call a V bottom in the T-bonds. No, it's not going to be a sustainable rally in the bonds, meaning if yields start dropping, it's just a counter trend rally in bonds and a contrary drop in yields. It's not going to sustain, but it could be impressive. And I think during that process, that's when gold's going to get a breath of air and be in sync with the upturn in the T-bonds this time. And except different, gold will be far more dynamic.
According to Minneapolis Fed President Neil Kashkari, there's roughly a 50-50 chance that interest rates will need to rise significantly to curb inflation. If the Fed avoids more rate hikes, it could boost gold's future performance. What are your thoughts on the interview? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.